Everything is starting to feel off. You can sense it in the markets. You can sense it in the economy. And for the first time in years, institutions that normally whisper are speaking loudly. A sudden change in tone is sweeping across financial regulators, central banks, global lenders, and analysts. And when institutions that normally understate everything begin issuing warnings, it means one thing. The danger is already here. What's coming next won't look like 2008. It won't look like the dot-com crash. And it won't look like the inflation spike of 2021. What's building right now is something entirely new. A multi-layered financial threat created by AI speculation, sovereign debt overload, private credit fragility, and household exhaustion, converging into one giant pressure point. And if the pressure breaks, it won't be slow. It will be fast, brutal, and global. Today, we're going to break down why central banks around the world are quietly panicking, how the most fragile parts of the financial system are the ones you cannot see, what triggers a modern crash, and most importantly, how to protect yourself and your money before this all snaps. Stay with me, because by the end of this video, you'll understand how close we are to a systemic break, and how to position yourself so you're not on the wrong side of it. Welcome to the channel. Let's begin. Section 1, the warning. No one expected. Something unprecedented happened this year. A major central bank, one that normally hides behind calm, neutral language, released a financial stability assessment that felt less like a technical report and more like a controlled panic. Their message was simple. Risk in the financial system has sharply worsened. Now, regulators never use words like sharp or worsened unless they're trying to communicate urgency without sparking chaos. But the details of the report were even more alarming. Global tensions, increasing trade networks breaking down sovereign debt, becoming unstable. Cyber threats, rising AI-linked assets in bubble territory. The most shocking line? AI sector valuations now resemble the peak of previous speculative bubbles. Think about that. We are living in the aftermath of the most aggressive money printing era in history, and the largest tech boom the world has ever seen. And regulators are saying the valuations are so inflated they resemble 2000 and 2008. And what happened after those moments? Markets fell by roughly 40%. But this time, it's worse, because unlike that dot-com bubble, today's AI boom is being funded by something far more dangerous. Debt. Section 2, the new bubble is built out of debt. Here's the part most analysts don't want to talk about. AI infrastructure expansion isn't being funded by profits. It's being funded by borrowed money, corporate debt, private credit, leveraged loans, shadow finance. Debt amplifies growth on the way up, but it multiplies destruction on the way down. And all of this borrowed money is being layered into data centers, chip production, cloud infrastructure, AI tool startups, compute, leasing software expansion, automation, research. But here's the catch. If AI stocks fall, even by 10 to 15%, it triggers a violent chain reaction. Debt becomes heavier. Companies must cut spending. Private lenders panic. Investors withdraw. Liquidity evaporates. Forced selling begins. Markets collapse. This isn't theory, this is math. Debt doesn't shrink when asset prices fall. Debt stays the same while everything around it drops. That's exactly what happened in 2008. But this time, something is different. The risk isn't inside banks. The risk is outside them. Section 3, the danger is in the shadow banking system. Most people think crashes come from banks failing. Not anymore. The biggest risks today live in something called non-bank financial institutions. These include private equity, private credit lenders, hedge funds, insurance-based financing, structured credit, digital asset lenders. This entire ecosystem has become enormous, much larger than it was before the last crash. And here's the terrifying part. This ecosystem has never been tested in a real recession. There is no stress test, no data, no track record. Regulators literally admitted this sector has never been through a downturn of this size. That is the institutional equivalent of saying, we don't know how bad this can get. In other words, the system is flying blind. Section 4, why this crash could be instant. Old financial systems moved slowly. Today's system is digital, instant, algorithmic. Risk is no longer sequential, it's explosive. A modern crash looks like this. AI stocks fall, private lenders freeze, liquidity dries up, hedge funds unwind positions, margin calls trigger fire sales, sovereign bond markets wobble, governments panic, household defaults rise, markets collapse. And here's the most chilling part. This entire sequence could happen in 48 hours. Not 48 days, not 48 weeks, 2 days. Because everything is automated, margin triggers, liquidation algorithms, bond repricing credit, spreads ETF flows, the crash will be algorithmic. Section 5, households are the final weak link. On the surface, households look stable, but underneath, household stability is being held together by cutting discretionary spending, reducing savings, delaying big purchases, renting for longer living, paycheck to paycheck, absorbing rising costs. This is not stability, this is survival mode. Once pressure increases, even slightly, households break rapidly. And when households break, small businesses lose customers, hiring slows, defaults rise, tax revenue falls. Governments face funding gaps, the recession accelerates. Households are the powder keg. One spark triggers the entire explosion. Section 6, sovereign debt, the unstoppable time bomb. This is the part politicians don't want you to understand. Governments around the world are drowning in debt. Many are now at record high. Debt to GDP ratios, interest obligations, refinancing burdens. In 2008, governments could save the system because they had room to borrow. Today, they don't. Central banks hinted at this when they said, government rescue capacity is limited. Let me translate that. If the system collapses today, governments may not be able to save it. That means no massive bank bailouts, no trillion-dollar stimulus, no unlimited liquidity access. The safety net is gone. Section 7, what will trigger the next crash? There are 3 likely scenarios. Scenario 1, soft landing, low probability. The market corrects gradually, debt is rolled over, liquidity stabilizes, confidence returns. This is the dream scenario. But history shows soft landings are extremely rare, especially when debt is this high. Scenario 2, contained failure, moderate probability. One sector collapses. AI. Commercial real estate, private credit, sovereign bonds. The damage is heavy but contained. This is possible, but unlikely due to global interconnectedness. Scenario 3, systemic break, high probability. 5 things happen at once. Asset prices fall, liquidity evaporates, debt becomes unpayable, governments lose control, markets panic. This is the scenario regulators fear the most, and it is becoming increasingly likely. Section 8, how to protect yourself right now. This is the part that matters most. Here are practical protections. Anyone can start implementing immediately. 1, build a real emergency fund. This is not optional. In a crisis, credit lines get cut. Banks tighten lending layoffs, spike expenses rise. Cash is survival. Aim for 3 or 12 months depending on your risk level. 2, reduce high interest debt. Debt becomes a trap during recessions. Pay off. Credit cards. Variable rate loans, personal loans, high interest, liabilities. Every dollar of debt you eliminate is equivalent to income you don't need later. 3, diversify your income. Do not rely on one stream. Build freelance income, digital skills, remote work abilities, part-time revenue side. Income streams. In a downturn, income diversity, strong survival. 4, avoid overpriced assets. Some areas are in bubble territory, AI hype stocks. Overleveraged tech, unprofitable startups, speculative crypto projects, real estate in bubble cities, preserve capital. 5, strengthen your skills. The best hedge against recession is you. Skills survive every crash. Tech skills, marketing, sales, engineering, design, finance, healthcare trades. Skills are inflation-proof, recession-proof, and career-proof. 6, hold some crisis assets. Historically, the following tend to hold value: cash, gold, treasury bills, recession-resistant dividends, essential service companies. This isn't about timing the market, it's about hedging risk. 7, stop ignoring the warnings. Every major crash follows the same pattern. First comes the silence, then the warnings, then the denial, then the collapse. We are in the warnings phase right now. Section 9, the big truth, expanded. Here's the part nobody wants to say out loud, but everyone feels in their gut. We built a financial system that only evolves after collapse. Not before, not during the warning signs, not during the calm. Only after everything breaks. Because modern finance isn't designed for prevention. It's designed for reaction. We patch problems after they explode. We redesign systems after they fail. We learn lessons after people get wiped out. It has always been this way. 1929, markets collapsed, then reforms came. 1970s, inflation exploded, then monetary policy was reinvented. 2000, the tech bubble burst, then regulations tightened. 2008, the system melted down, then safeguards were installed. But notice the pattern. The collapse always comes first. The redesign always comes second. And that's the uncomfortable truth. Change will not come through planning. Change will come through pain. Every collapse exposes the parts of the system that were weak all along. Every fragility that was ignored eventually demands attention. Every flaw that was hidden eventually becomes impossible to deny. Collapse is the teacher. Pain is the reformer. And crisis is the architect. But here's the part that matters most. The part no one ever teaches. You don't need to predict the collapse. You just need to survive it. Your goal is not to outsmart the system. Your goal is to remain standing after it breaks. Because when the dust settles, when markets stop falling, when governments stop scrambling, the people who survive, the ones who protected themselves early, are the ones who rebuild, reinvest, and rise stronger. And survival never happens by accident. It happens through preparation. Outro. The choice you must make now. Expanded. A major financial crash is not a matter of if, it is a matter of when. Look around. Global debt is at levels humanity has never seen before. Speculation is extreme, fragile, and accelerating. The real economy is slowing. Households are stretched thin, governments are out of ammunition, and markets are priced for absolute perfection. One wrong move, one global shock, one liquidity squeeze, and the entire structure can unravel. This is not sustainable. This is not stable. This is not normal. The storm is coming, whether it begins in tech, in sovereign debt, in banks, in real estate, or in the shadow finance world. It doesn't matter. What matters is whether you're ready. Because when crashes come, they don't warn you. They don't schedule themselves. They don't politely arrive at a convenient time. They hit suddenly, they hit violently, and they hit everyone at once. The difference between those who survive and those who don't is preparation. So ask yourself, honestly, are you prepared? Have you positioned yourself to withstand volatility? Have you reduced exposure to fragile debts? Have you built cash reserves? Have you built skills that survive recessions? Have you diversified beyond a single fragile system? These choices matter, because nobody is coming to save you, not governments, not banks, not corporations. Your financial survival is in your hands. If you want updates as this situation develops, subscribe. I break down the truth, not the headlines, and I'll show you what's happening before everyone else sees it, and drop a comment. Do you think the next crash will be worse than 2008? I genuinely want to know what you think. Because this story, this unfolding financial storm, is only just beginning, and it may become the defining economic event of our lifetime. Until then, stay prepared, stay sharp, stay aware. And I'll see you in the next video.